Good morning, welcome to Market Wrap number 170. Stuart Williamson here at the helm. This week we're in Singapore, as you can see in the background, a glorious place. We're continuing our client networking series, which started in Dubai, Abu Dhabi last week. Yesterday we were in the Royal Hong Kong Yacht Club, lovely place, great people, had a really good turnout. This week, as I said, Singapore. Great turnout of investors and interesting clients. Tonight at the Tower Club, we're hoping for possibly 100 people, which is lovely. The discussion topics have been, is it the wrong time or the right time to buy in the UK? As I've said before many times, I don't believe it's ever the wrong time. I don't think it's ever the right time. Look at last week's SWOT analysis and make your own minds up. Please have a look at the videos of the experiences we've had and look at some of the questions and the answers that clients have been asking and our speakers have been talking about. What would indicate that potentially we're at possibly is the right time to start buying again sort of area is the UK's headline rate of inflation slowed to 6.7% year to date yesterday for August 2023, down from 6.9%. That's only 1.1%, so it doesn't seem like a lot. But they are official figures, but officials were expecting a rise due to fuel prices. So they're expecting to go over 7%. So to be under last month's figures is great. It looks very positive. Core CPI, which excludes volatile items such as energy, food, alcohol and tobacco, slowed to 6.2%, down from 6.9%. The services consumer price index, which is particularly susceptible to wage rises, slowed to 6.1% from 6.5%. Now today there's a Bank of England Monetary Policy Committee meeting to assess whether to increase rates. There's been talk about it going by 0.25%. And that could be the last in a cycle. However, these changes could mean there is no rise. It's today, Thursday. I'm recording this a day early, so we can get it out tomorrow as we're doing the seminar tonight. Great quote from Simon French, Chief Economist at Panmure Gordon. And he says, holding rates this week looks now a materially underpriced outcome. I'm not entirely sure what that means, but it sounds quite positive. So that's good. It's a good thing. Volatility in the mortgage market will slow. People can plan better, and that's a big thing that a lot of our clients are having problems with, is mortgages are seen to change their rates so often. It leads to frustration and a lot of anger out there. However, the downsides are that the fact remains the same that UK wages are now rising faster than the rate of inflation. Services prices are coming down, but too slowly for comfort, according to the ONS. These conditions are replicated to a greater or lesser extent across advanced economies, presenting central bankers with difficult choices as they seek to walk the line between avoiding recessions whilst ensuring momentum doesn't return to inflation. And that appears to be the focus of what the OECD are saying as well in their most recent economic outlook. They say uncertainty about the strength and speed of monetary policy transmission and the persistence of inflation are key concerns. The adverse effects of higher interest rates could prove stronger than expected, and greater inflation persistence would require additional policy tightening that might expose financial vulnerabilities, i.e. the underlying economies in the UK, for example, is pretty shot post-Brexit. There's a lot of figures from them about global economy and so on and so forth. They expect it to grow by 3% in 2023, less in 2024. Most of that growth is expected to come from Asia, but not China. Activity is already weakened in the euro area, reflecting the lagged effect of incomes from the large energy price shock in 2022 and comparatively importance of bank-based finance in many European economies. So the UK and Europe are going to be behind. The Europe, they're looking at 0.6 and 1.1%, and the UK is worse. So we're worse of all the G7 countries. So that's bad for the UK economy. It's got to, Rishi Sunak and his merry men and ladies have got to sort it out sooner or later. So OECD is looking at a fairly grim outlook for Europe, but Far East Asia quite positive. In the global housing market, the OECD notes falls in house prices from their peaks in some G20 economies, Korea, Germany, United Kingdom specifically. Housing investment has declined, especially in the US and Canada. It says some signs of stabilisation began to appear in recent monthly data, That's been supported by structural factors such as robust population growth and limited inventory of houses for sale. Prices have turned back up, house prices have turned back up, that is, in the United States, Canada and Australia. So it's exactly what we're talking about. We're talking about not enough property being built and people coming into the country and using it, and there not being enough to go around. So it's forcing up house prices, it's forcing up rental rates. It's a toxic cocktail. Unless they build more houses, isn't going to get any better. And it's something that the government does not seem to and they don't seem to have any concept of how to get around it. The OECD goes on to say, if there is a housing fall, people will stop spending because of mortgage defaults. They haven't seen that as yet, and they don't see any evidence that will occur. So they're saying there's plenty of danger out there. So is it the right time to buy? Perhaps they're saying no. Perhaps their view is you don't buy now, and you've got to make a decision for yourself. You know, it's all a case of where, not should you, because there are still good locations out there you can buy at. So if you look at the rental markets now, what's happening? Every year, Good Lord and Vouch release an annual State of Lettings industry report. It's very well known and very well respected. And what they do is they bring together views of more than 2,000 letting agents, landlords and tenants across England, Wales and Scotland who are surveyed on more than 100 different topics. So it's quite a broad survey, which is very good. They go on to say, following many months of media discussion about rising tenant demand and landlords leaving the market, this year's report offers actual insights, not chat, not what I heard down the pub, but actual insights. It's quite statistically focused, so forgive me as I regurgitate it. Over the last 12 months, 78% of letting agents polled saw increased demand for tenants looking for homes. However, 58% of agents also reported an increase in the scarcity of available properties. Some 76% of tenants who moved between July 22 and July 23 said they found it difficult to find a rental property. And 13% of them said they ended up paying more rent per month than was originally advertised at the rate for that year. Meanwhile, there's growing evidence that landlords are leaving the market. Over the last 12 months, 95% of letting agents saw at least one of their landlords sell at least one of their properties, whilst nearly a quarter of agents saw up to 20% of the landlords selling at least one of their properties. So, not a lot of changes in the rental market, still not enough supply because we aren't building enough houses and there's people coming in. It's an investment opportunity if you have the cash, if you buy wisely and have a large enough deposit. So, what are the options? Some councils, it would appear, are taking matters into their own hands and trying to deal with it independently, which is fantastic. Newham Council plans to buy homes from landlords. It's a radical scheme that will see it buy properties from private landlords in order to stop tenants being evicted and made homeless. Initial 20 million has been allocated for the scheme, which is designed to prevent tenants from becoming a drain on homelessness services. With this cash, the council plans to buy 44 properties of £450,000 each, as well as undertake refurbishment works. Councillor Shaban Mohammed, Cabinet Minister for Housing Management and Modernisation, said, "We're doing everything we can to maximise the supply of housing in Newham, including purchasing properties and building new ones, as we try to provide vulnerable residents with a secure home and reduce the number of people living in costly nightly paid accommodation. The scale of the challenge is immense and we cannot face it alone." That is fantastic what they're doing. That is so go it alone, well done. Newham has the highest number of households in temporary accommodation in the country at 5,878. Of this, 3,193, so 55%, were placed in nightly booked properties, hotels. That's blown 2 million black hole in their homeless budget. Landlords in the Newham region are currently giving notice on 350 homes being used as short-term accommodation. Lewisham Council in London has also committed to buying 300 1, 2 and 3 bed homes worth up to £600,000 each. So that is proper thinking outside the box. Well done to those councils. Perhaps other councils, even the government, should consider that approach. I don't know whether it's good or bad in reality, but it seems to be a short-term fix. is basically taking back over council houses, ones that perhaps should never have been sold by Margaret Thatcher. So that's it for this week. Do like, subscribe, and do share if you can. But don't if you don't want to. I'm fine with that too. Great with the comments. Thank you very much. Take care. Cheerio.